Hey guys, simulate and trade here. Today's video will be a little more complex in nature, since we are going to be expanding on some of the material we talk daily about. This video has a variety of purposes, but main among all of them is to provide you with a broader understanding of the relationship that meme stocks GameStop and AMC have with ETFs. I believe most people understand the basics as to ETFs that follow our beloved stocks being shorted and manipulated to attack the prices. However, the relationship between these two is more complex, and its intricacies and development is almost a field of study for pretty much anyone that is a big name on subreddit Superstonk. As such, many references had to be made, and I thank two entities in particular, though their work is often the work of others with added substance. We all work collectively to unravel this ever-growing mystery that is AMC and GameStop. First, let me extend my gratitude to Broca. Broca has been an invaluable asset in this process, particularly for me being my idol in all of this. His data analysis is second to none and provides some of the fundamental structure of this video. The second person who I want to extend my never-ending gratitude is Dentist FT, whose take on the cycles aligned with mine and has given me confidence in my own assertions by contributing a key blueprint for understanding why it is GME in particular is lagging and then out of nowhere jumps really high. And lastly, I want to thank all my Patreons and single-time donors for helping me bring these types of videos to you guys. We are going to cover some really interesting stuff and clarification on two main issues, those being in regards to the NSC 2021-002 and regarding GameStop in particular. I only ask one thing from you, and that is that if you find the content of this video enlightening to you, if you feel some wrinkles were added to your ever-evolving brain, not only that you drop a like on the video, but to also let me know in the comments if you enjoy this type of video and what kind of topic you would like for me to break down. None of what I am about to discuss is financial advice. Everything is subject to my own biases and experience. With all of this said, let's raise some IQ points without any further delay. Many of us have been looking at the growth in reverse repo operations conducted by the Fed. In fact, over the past couple of weeks, we have discussed almost daily what this increase in reverse repo operations mean for AMC and GameStop. As discussed in my last video, the success in our stocks lies in the fact that they work almost like a hedge against overall poor market conditions. The market shakes a bit, and even if AMC or GME slips, they recover strong back up. They cannot fail because their success lies precisely on poor market conditions. However, this also works as a counter-argument, because so long as the market remains as it has been, it will not prompt the squeeze anytime soon. However, as was heavily implied in my last video, the Fed and their reverse repo, for as much as they work to illustrate the condition of our economy, they will not be the cause of a squeeze. Oh no, the answer lies in failed to deliver stocks. But to be able to understand exactly what is going on with failed to deliver stocks, or FTDs as we will proceed to call them throughout the rest of the video, we must understand the relationship between AMC, GameStop and the small cap IWM. IWM is a small cap ETF that belongs to the Russell 2000, and this is where we will start. The IWM ETF has strong connections and ties to GME and AMC due to the fact that it has a large amount of stocks in each of them. In fact, as of the last time I checked, the ETF had a GameStop value totaled almost at $200 million while having around $10 million for AMC. Now, compiling volumetric data among performance to look for correlations between each of these three securities brings up some very interesting results that will have you scratching your head. During the month of May, there was a big, and by big, I mean huge number of FTDs on IWM. The numbers were almost reaching $1 billion. For reference, ladies and gentlemen, on the month of December there was around $1.5 billion worth of FTDs on the ETF, but let's stick to May for now since it was the most recent. Due to the gracious courtesy of Broca and his ability in inputting all the data, you will see that all the way from May 11th to May 14th, IWM ETF had a huge spike in FTDs. But this isn't enough. Compiling even more data all the way from early year 2020, we see huge spikes, 3 being over 8 million shares in failed to deliver for GME alone. Now that we have seen the undeniable data, let's talk dirty. We know that there is a huge catalyst coming up for GameStop, and that is that it has a perfect shot to being added to the more pristine Russell 1000, which will have a ton of implications. Looking at the data I showed you, you saw 20 ETFs that follow GME and you saw how much they are being screwed and manipulated through failed to deliver in order to move the stock. If GameStop is transferred out of the Russell 2000, what will that mean for all the shorting that is happening? How will hedge funds adapt to maintain it down? We know that when the transfer happens, GameStop will initially experience a lot of volatility and sell volumes, since being transferred will force Russell 2000 to have to sell in order for Russell 1000 ETFs to be able to buy. The shift that is about to occur will be one of the most important catalysts happening, because the data that will be compiled will give us a framework to determine exactly what is happening outside of IWM. With such framework, we can better determine and model GME's behavior so that we can better calculate its real position. The good news in all of this is that there is already a thesis that anyone looking at FTDs has derived, and it has to do with cycles. I do not remember if it was through Twitter or on my YouTube, but I had once talked long back about how hedge funds were begrudgingly covering their FTDs, or buying them back, on the last possible days in order to delay and stretch the process of buying pressure in order to have the stock not strongly consolidate upwards and be more vulnerable to be attacked. This is one of the things I have been saying almost daily on my recap videos, where GME is constantly attacked and not allowed too much time to consolidate and build those strong support walls that are so needed. This is also happening not on the daily time charts alone, but also on the monthly time charts. The way hedge funds are operating is they don't buy anything until the very last day they have to, by which the price of GameStop starts kicking off in bullish volume. Now, the thing you have to remember is this has to do solely with IWM in particular and the other ETFs that follow GME because of the biggest number of shares. Remember, the action is sometimes super small as it is reflected on the chart, but what happens when we just account for GME FTDs? Oh boy, do things start to change. The price action is sometimes pretty substantial, to be honest. Now, this is where things get confusing, even for me, but alas, my man dentist came up with a great answer that explains why GME trading is so weird and nonsensical. As he so cleverly pointed out, there is a time frame that restarts on Wednesdays and only on Wednesdays before options expire that extends 9 days, where financial companies need to make large deposits to the NSCC. Oh yeah, you know, the ones that on this past Friday quite literally updated and set their new ruling that act as stronger liquidity requirements for hedge funds, but more on that later. Just remember, all that is happening from the GME transition from the Russell 2000 to the Russell 1000 to options and failed to deliver to the NSCC, it is all connected and is not happening at the same time just out of strange circumstances, but let me continue as we were going and I promise to tie it all up in the end. So, big money has to make these larger deposits to the NSCC in this extended 9-day period that starts on Wednesdays before monthly options. Obviously, through these 9 days, having to make these large deposits to the NSCC means that they have a lot less cash, less funds available to them. Now, we know that the rules were super soft until the NSCC and overall DTCC started making big amendments requiring a ton more liquidity. But even as relaxed as their requirements were, hedge funds and market makers along with banks have to act extremely careful, because it is during these moments that they are in most danger, because since they don't have as much money, they could easily get margin called and start the squeeze if a liquidity requirement is demanded and not met. So what does this mean? Well, guys, we actually have a freaking understanding of why GME is behaving the way it is. Something actually interesting happens during these moments. When the FTDs are finally paid out at last moment by hedge funds, and this goes for the stock in general, though IWM also, but to a lesser degree, except on times where we see those huge spikes, those FTDs that are finally paid actually rise and set the freaking GME floor. Yes, sir, people, we understand now how exactly the GME floor works. Get jacked. OMG, my processors are melting. The surges we see are in direct correlation with this 9-day period by which the floor is lifted. Even when the price retracts back down, it doesn't really retest previous support. This is absolutely insane and I am super jacked. And now, let's discuss the last key piece of information. Let's clear up the air and verify that no, NSC002 did not get approved this past Friday, which was what many people were saying. It is set with a deadline for approval on Monday, June 21st, which is tomorrow. Let us not start assuming it will get approved, because as we have seen, things can happen. DTC005 took months to return and be passed, so let us abstain from dangerous assumptions. I am confident we will get it approved tomorrow, but I am not celebrating until it is done so. This change aims to update the supplemental liquidity deposit, or essentially it updates the minimum requirement of funds needed to be paid up front as a way to manage risk. It more than anything tightens the frame by which hedge funds can manipulate, and it most certainly doesn't mean tomorrow we get the squeeze, as I have already seen some saying. Everything in due time, ladies and gents. As we discussed, this works in great conjunction with what we just talked about. This updated liquidity requirement, it means that volatility in that 9-day time frame might get jumpier. There is a lot happening with GME, and therefore AMC as a direct result. I know this video has had a lot of technical factors and I hope it was clear for you. Even though it may not have all the answers, we now finally have a blueprint of how things are happening and can more or less model predictive behavior. As we fine-tune this, we will eventually be able to deduce an estimate on how many naked shorts there are, which we can then more or less use to establish the real floor price. Before we quickly talk about technical analysis, let me know in the comments if this info has you jacked, if you liked it, if you want more of this type of content in the future, or if you want me to further break it down because it is too difficult for you to follow. Seriously, scroll and comment below please. Looking at the chart, I think it is almost freaking impossible to determine what GME could move to, but I know it will soon be experiencing a ton of volatility. If it falls, I can see it falling back to 205 before a small bounce. If it drops below 200, then I might see it stop at 192. Below that it would stop at 188. Now, if we get a nice little boost, I think we head to 224 before we stop. If the buy pressure is big enough, we pass and fly easily close to 240. Again, with such a big catalyst coming, GME will not be behaving under the normal parameters it normal trades under. As such, I expect the price to be difficult to predict in direction for this week and will rather stick to probability on the day-to-day basis. The stock is severely oversold as of Friday and it should honestly be moving up relatively shortly. My personal bet is on a bullish performance soon enough. Listen, I am going to be as plain and basic as my wife. AMC is undersold and it should honestly be moving up. That last attempt by hedge funds to dip the price to close under 60 will be short-lived and we should start seeing some serious buying action. The stock should be trading above 65 and I think that will be the case. All those options expiring in the money, even though they may or may not be hedged, I still think we will see a reaction in the market. It will be super interesting. I think we are severely oversold and we will bounce up even if momentarily. Expect support at 58 and 51 short terms. Worst comes to worse, we hit $40 again before a bounce up. As such, I want to thank all of you for sticking with me, and in particular to Broca and Dentist FT. I want to thank all of Reddit, to be honest, for having great apes. It is hard to find good DD, but sometimes I find good stuff that helps me build my own analysis and theories, and for that I am eternally grateful. Drop a like on the video, and please consider joining my Patreon if you enjoy this content. YouTube pays me so bad my wife's boyfriend doesn't even ask for money anymore. In all seriousness, it really helps the channel. Thank you, and I will see you in the comments below, which I expect all of you to be.